From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 4th. You're listening to the HPS Macrocast, and you're listening on a big jobs day, non-farm payroll Friday. We have our regulars, John Fagan, Brendan Walsh with Markets Policy Partners, and as always on every jobs day, the great Matt McDonald is with us from Hamilton Place Strategies, and I'm Tony Fratto. Matt, what do the numbers tell us? I think there's a little bit of intrigue in the numbers today, isn't there?
There's always intrigue in the numbers. Sometimes you have to squint harder than others. The numbers are good today. Non-farm payroll rose by 1.4 million in August, and the unemployment rate fell to 8.4%. And just to put those in a little bit of context, the 1.4 million increase is, I would say, is strong, is kind of, you're getting a little bit of, I don't know what you'd call it, a little bit of diminishing returns on the back end. We had a sharp bump, like June numbers were, 4.8 million, July is 1.7, now August is 1.4. So that makes sense. You're obviously not going to get as big a spike as you go on, but a really strong number in the 8.4% unemployment is kind of a, what would you call that? Like a normal elevated unemployment rate? Like it's not good, but it's not like pandemic crazy mid-teens kind of thing that was the discussion previously.
Yeah, so that's back into the range of like really bad recession numbers.
Yeah.
Right.
Yeah, like bad recession, but not like generational pandemic depression type.
Yeah. And the most interesting data point I saw from the household survey, that's the one that the unemployment rate is done.
Yes.
So much of the improvement was people that were laid off for 5 to 14 weeks. So 2 million people came back. But unfortunately, for people that have been laid off for 15 to 26 weeks, only 33,000 came back.
Yes.
So it seems like we're really getting this K-shaped, where people that were genuinely out of work because, it's shut down and now you're reopened, those people are back to work. But there does seem to be a large chunk of the economy that just isn't coming back to work.
And that's and there's parts of that are borne out, I would say, in the industry breakdown too. So if you look at kind of where that 1.4 came, you had a 250,000 jobs added in retail. Professional and business services was about 200,000. Leisure and hospitality was 175,000 added. Education and health services is still down a lot, but that added 150,000. Warehousing was up 80,000, which those could be permanent new jobs that are being created rather than replacement. But so you do have a little bit of, I guess the question on some of this stuff is that it feels like the job market continues to kind of pluck the low-hanging fruit of, okay, this job went away, this job is coming back. And, the question I think is that not all the jobs are going to come back.
Yeah.
And what does that look like? When do we hit that point where you start getting, like the harder work on restoring the economy? And I think that from a policymaker perspective, some of the danger on this, and this is where you see certainly conversations of what we saw from the Fed in, I guess it's Jackson Hole, but not Jackson Hole, whatever.
But we actually got to attend Jackson Hole this year, so it was much more. It was better for us, I guess.
Kansas City Symposium.
Yeah. So I guess the question is, assuming that you're getting, you're going to get some dead cat bounce on some of this stuff, is what are the policy choices that you make now to ensure that the recovery is as deep as the crash?
And I think that when you look at the wage average hourly earnings, it was a pretty big surprise to the upside, 0.4. But unfortunately, I think it's good and bad. I think the reason that it was a surprise is because higher paying jobs are coming back to work, but the low paying jobs just aren't. And it's the reality. Restaurants, movie theaters are just not open. So that's where the Fed needs to it's Main Street, and we talked a million times about Main Street lending. People, well, also within this report, about 30 million people were able to work remote, but 24 million people weren't able to get a job or attend to have their jobs cut because they weren't able to go to the office.
One other big segment of supported. In fact, I would look. I think the numbers, if you add them up, it's around a quarter of job creation and the support came from government, including a couple 100,000 census workers.
Yeah, you kind of got to back out the census workers. That's a one-time deal.
So like the couple 100,000 census workers are a one-time deal. They're going to roll back off in a few months.
And it's not really a one-time deal. It does happen every 10 years.
Short-term employment. They're going to roll back off government payrolls pretty soon. And a big chunk of those government workers, it's not like government was creating new jobs. Those were certainly the other public sector jobs were back to work jobs. I think public sector is still shedding jobs overall on a net basis, or at least I'm sorry, not on a net basis, but going back to pre-COVID days, are still government is still significantly down. So you're not going to get that government boost. August is the last month where I think you can feel confident so far that we've had significant fiscal support. We're going to see a gap here in September. So the numbers for September, when we get to the first week of October, a month from now, and look back at September, it'll be really interesting. We've seen a number of high-profile layoffs. We're still seeing very elevated, as we saw yesterday, and maybe we could talk about weekly claims, which we had, a change in the methodology, which we could talk about. But, so the headline number, if you weren't aware of the methodology changed last week for weekly claims, looked good. It was actually a bad number.
Very bad, yeah.
Very, very bad number on weekly claims. So, so I think we have this snapshot of August, which is with, really substantial monetary support, unprecedented fiscal support, the end of unprecedented fiscal support. But now we are in the September period where the fiscal support has run out. Maybe monetary support has run its course. We are seeing the economy, we are seeing, in fact, back to work in a lot of places. There is a lot of back to work in retail and leisure and hospitality that has come back since, in the May, June, July period. Like some of that is real. It's not, there's no fakery going on there. It's real. Some manufacturing has come back. People have been able to source some supply and start making some stuff and selling some stuff. So some of that's real, but to what you guys talked about earlier, the question is always going to be not whether there's some comeback, but at what level are we going to settle into absent more fiscal support and absent solving the health crisis?
And I think that's the question really at the heart of the market response. I mean, this is the fifth straight month of upside surprise, and a lot of them have been pretty meaningful upside surprises. This was a little bit more subtle, but a significant beat on the unemployment rate this time. We've seen really strong non-farm payrolls. This is the most market moving of all, traditionally the most market moving of all U.S. economic readings, and where you would typically see these the reactions in longer dated treasury yields to these upside surprises, lifting those yields, boosting the dollar. Boy, those are the reactions are absolutely muted. They are not giving either there's something else in play, and you can, everybody points fingers at the Fed and the generous liquidity provisions anesthetizing these markets to some extent. That's possible, and there are other factors in play. But on face value, these financial markets are not giving these better than expected pieces of U.S. economic data, including the non-farm payrolls, a lot of credit. And there's a sense that the Fed officials have been absolutely unanimous on this front, which is this is a rebound, but the pace is leveling off, and we have very little clarity on the months ahead. So there's a degree of caution, and certainly the shift in the Fed's thinking and the thinking around the country to focus on, to drill down and look at the lower income and the racial breakdown of these kind of numbers, those obviously, unsurprisingly don't look as good as you get down into, Black and African American unemployment rates, and some of the other things that the Fed is, and workers without a high school diploma, for instance, things that the Fed is increasingly, and the rest of us are increasingly focused on because of events this year.
I also think, Tony, you made a good point about there's been a lot of high-profile layoff announcements coming, and I think a lot of that has to do with the PPP loans run out in September, and also it looks like we're also going to have a cliff of the other support that's coming. So, maybe the market's looking forward that the fall is not going to be quite as good in terms of the jobs market as the summer has been.
Yeah, I mean, we'll see, right? I mean, we're going to get the question is how much of a handoff is there to the private sector? The permanent Matt, if you look at we saw workforce participation up. I mean, Brendan talked about the long-term unemployed, which, and our friend, the economist Martha Gimbel, has a chart out on Twitter showing that the numbers of people in that group of that long-term unemployed really are, if we talk about 8.4% being, in that normal range of a recession through long-term unemployed number, people 15 to 26 weeks is unprecedentedly high. And the thing that she always harps on and we're aware of from the previous two recessions is that the longer you stay long-term unemployed, the harder you are, the harder it is for you to get a job in the future. You just become less attractive to employers.
So a year ago, it was 831,000 people were 15 to 26 weeks. Now we're at 6.5 million. And then 27 weeks and over, we're at 1.6 million. That's
a good point, Tony. And then the other two aspects of the related conversation that you will 100% hear about in the coming year is the impact of graduating into an economic environment like this and the lasting damage it does to someone's career path prospects. And the second dynamic that you will see, which has some unique aspects, is actually for older workers who've been laid off and are between 55 and 65 and caught in that no man's land of nobody's really excited to hire them for the long term when they're going to retire and that sort of stuff. We're in a really weird spot for that particular population because of the proximity we are to kind of the last of the baby boomer retirements.
Yeah. And we also know that
be a large group that is impacted.
Yeah. That group, that 55 to 65 really needs to keep working because they haven't saved for retirement.
Yeah.
I guess that's a nice opportunity to just note that HPS is all recruiting for associates and analysts for our HPS leadership program. You can find the link on our website to apply if you are a senior in one of America's great colleges right now.
I was at I had to pick up mail at the office the other day. So when we do finally go back to the office, it is a pretty cool office to work in.
Someday we'll be back.
We're going to have cocktails on the porch.
One interesting aspect is of this is you have kind of we've talked about the Fed support. We've talked about the fiscal support. It will be interesting to see whether the actual conclusion of the pandemic is kind of gradual or a shock. It could come in the form of, look, there could be a tough second wave. It could come in the form of some of the rapid iteration testing that's out there could actually really impact the ability to contain the virus, or it could come in the form of a vaccine, and it will be interesting to see how that intersects with the economy and what that looks like. Cause I could see it in a scenario where if that comes as a shock, it would have a positive economic shock as well, which I'm not sure is something to bank on, but it'll be interesting to see how the eventual end of the pandemic intersects with
Okay.
the job market and the economy more generally.
That's a really interesting point, and we've talked about that from a financial market perspective, and we'll talk a little bit more about it when we get into the sell-off. But the Fed is pivoting clearly in the messaging about their reformulation of their inflation targeting and also their unemployment mandate to focus on lower income echelons is about in part about delinking their policy going forward from public health outcomes. I mean, you could easily see a formulation where the Fed could reasonably say, hey, once a vaccine is out and reasonably viable, the market needs to be on notice that the next move is going to be incremental tightening or withdrawal of the stimulus, normalization. And that is not what the Fed is saying. The Fed is saying that, it's trying to deaden that potential for a shock to the treasury markets or, the dollar or whatever it is, markets in general, to what you're saying, Matt, which is, on the day we hopefully that it's coming soon when we wake up and see an announcement of very successful vaccine trials by AstraZeneca or Moderna or one of the others, that the markets aren't lurching and disorderly in a massive reset back to normalcy.
It has this quality, very early on when we were discussing this, we were talking about the way that the economic policy responses to this stuff was building a bridge so that you can insulate the economy as best you can from the pandemic, et cetera. The thing is that it's building a bridge where you don't know where the other shore is.
Yeah.
You're just out in the middle of whatever the body of water is. You just keep building the bridge and you don't know where it's going to land. And it's very difficult to figure out what the optimal outcome is, what the end looks like, how you think about that, how you manage through that when the variability of kind of the length of time is high.
Yeah. So right. So, but you do have to keep building the bridge until you're there. And then
yes,
that's the challenge to the Fed. The Fed could tie it to anticipated health events, but they certainly do not want to, encourage the market to anticipate that event, right? If you're like, they don't want to say definitively that, if a vaccine comes, we're withdrawing monetary support, because some in market participants try to get ahead of that. And it becomes, you start causing, negative economic events in anticipation of what might be a policy event. And for the challenge for the Fed is that the health outcomes and the efficacy of any of the vaccines or treatments is uncertain. So just because there's some, big announcement and the media goes wild with it, the media has, little consequence if 2 months later we find out that it's not as effective a vaccine as we thought it was going to be, right? And so, or the virus has mutated, and right. I mean, but the Fed has to be 100% certain. And by the way, they just changed their policy stance anyway to say that, at least, well, have they? But they've indicated they're going to be more dovish. We think they're going to be more dovish.
Yeah.
Well, I do want to get into where we think how markets are anticipating this news. We had a big sell-off. Why don't we take a break here, come back, and just dive into how markets are interpreting health news and official data. We'll be right back on the Macrocast.
On the first Friday of every month, HBS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
And we're back on the Macrocast. John Fagan, we had a big sell-off yesterday, after sort of an unprecedented, run in equity markets. But we had a big sell-off. I think at one point we're down more than 1,000 points in the Dow. What are markets seeing right now?
Well, the formulation that you put together, unprecedented run and sharp sell-off, do tend to go together in equity land, and so it was to some extent the commentary from the investment community was, gosh, this was overdue. These stocks were pretty ridiculously overbought. They were, just on a rocket ship to the moon for so long. They have, outperformed dramatically the rest of the index by whatever metric you want to say. The tech-led rally has been absolutely astonishing, and so in these circumstances, it's generally speaking, it's pretty common to have resets, even if you don't. The correction is, roughly around 10%. And, only the very worst performers really got anything close to an actual correction. But this is corrective activity. It's considered healthy. It was long overdue to some extent. It's coming at a time, the Thursday before Labor Day weekend, when liquidity is probably not at its most optimal, and not the desks, trading desks and so forth are underpopulated. And you also have, there is sort of a technical element to it that is perhaps comforting to analysts. We're also focused on the fact that we have seen setbacks for tech, and they have coincided in recent months with vaccine-related announcements. And if there is a logical symmetry here in which the winners of the pandemic, like big tech and some of the other prominent, if you're talking about Netflix or Zoom or Amazon, even Walmart, some of the large retailers that are benefiting from the closure of smaller stores, and their online presence growing and so forth. If you accept the premise that the pandemic has been very, very good relatively for these stocks, then, by that logic, then perhaps the outlook for viable vaccine in the coming months undermines their comparative advantage versus the rest of the index. And so you get this rotational aspect where people take profits on their high-flying pandemic winner tech stocks and go into the traditional economy. But as we've discussed on this podcast before, tech has gotten so dominant in these indexes that it's very hard for, traditionally like a rotation. If you're selling out of one part of the stock market and just buying into another, there tends to be stability at the index level. But these stocks are just so massive and such huge portions of the index. And, you can make the argument that the value stocks, the traditional economy stocks that have been lagging for a reason, because the economic outlook is pretty cloudy. It makes these rotations relatively unstable. And so we see big chunky moves that bring, in tech stocks like yesterday, that bring down the entire index. And it's, we're seeing a little bit of a bounce today. Tech has been very, very resilient, and we'll see how it plays out. But we think that if there is a vaccine that is going to be announced over the next few months, that really is a potential game changer, and it can change some of these prominent market dynamics that have prevailed through the pandemic.
Buying those, if you bought up those stocks over this time, first of all, if you bought them anticipating, changes in the economy over a period of 2 or 3 or 4 quarters, then you're just an idiot, right? I mean, that's too short term to. I mean, you could trade. I mean, trading is one thing, but if you were investing in those stocks, what you're imagining is that you have shifted forward the share of economic activity that they are going to capture for the long term, not for just over some period of months when a vaccine comes back, right? This isn't like, if you're talking about AMC movie theaters, that's one thing. But what your interest in Netflix is that consumers have changed their viewing patterns. They had the forced opportunity to enjoy Netflix content over the past 5 months, and to a greater degree than before, they're hooked on it. So I'm not saying that people aren't going to go to the movies anymore, they're just going to go marginally less to the movies, marginally more to Netflix. That's your long-term play with Netflix, right? So
yeah, that's the fundamental basis for it. But the extent to which momentum has taken over and taken that story and really, really run with it to some extremes, that's where the debate really lies. Has too much of that shift really been priced in? Is the outperformance over of tech stocks? This is when you go down and look at the gains per year, if you look, Facebook is up 40+%, Amazon up 82%, Tesla is up after this pretty chunky sell-off this week, is up almost 390% on the year still. Yeah. I mean, these are and great banks like JP Morgan stock is still down on the order of 30% on the year.
Elon is definitely getting his compensation marks.
No, I guess I'm a good example. Yeah, going into it, my two largest holdings were Tesla and PayPal. For that reason, I just thought that they're big winners in the world. And then also the pandemic happened. I'm not defending. I think the valuations are getting silly now, but I still like the companies. Yeah,
well, again, the difference between trading and investing. If you're an investor, you like the company and you like its long term. What this has done for it long term, right?
Yeah, but it's not a bad time to take some profits in.
I mean, the other theory on this stuff is that the pandemic is inducing fundamental behavioral changes.
Yeah,
right? And it's interesting. I don't think anybody really knows the answer to that. I think it's a little of both. I mean, I think that people are at once, when it is over, are going to be manic to get out and see other people and be among crowds and the things that we once took for granted. But the technological adaptation and adoption that has happened in many respects is, some of these things are overdue, candidly, that the technology existed. We just didn't have we didn't have a giant natural experiment to really adopt and see what would work and what wouldn't work. And so I do think that there's going to be some reversions, and there are going to be some serious behavioral changes that will impact some of these companies.
It's really important. Like we were talking about the bridge, when we get there, our behavior is going to be slightly different. I'm really excited to go to Buffalo Wild Wings and watch a football game, but I'm not excited to get back on a plane and fly 6 hours for an hour meeting,
That's a basic question, though. Look, if almost by definition, if there are a lot of companies out there that are overbought, there are a lot of companies out there that are underbought too, right?
Yeah.
So maybe it is Buffalo Wild Wings and Macy's and whatever. Should you be buying those companies right now, anticipating that 18 months from now, actually, they're going to be they're undervalued right now, and they're probably good buys. I mean, unless they're good buys because they're good buy, go away.
Exactly.
The market can't seem to get all that comfortable with the with what we call the value stocks, the real economy stocks. It's a little bit the rotations that we've seen from tech into real economy seem to be pretty brief, and the process of elimination, investors seem to get being only able to digest a certain amount of increase in exposure to the real economy stocks with the kind of difficult outlook and challenging cloudy crystal ball we have for growth. We also have the election coming up, which is a meaningful period of uncertainty for markets, and so there's a sense of at some point ringing the cash register, playing a little bit of defense, and trying to see if you get some clarity past some of these major uncertain points coming into year end. That's a reasonable stance for investors to be taking.
You know what? We have an HBS report out on volatility, or that we're working on volatility and elections, which is to say, actually, there isn't a whole lot of volatility with elections. A lot more perceived and talk in the chatter about increases in volatility leading up to election day. It's actually just not borne out very much in the data.
I can't wait to read that report, because we make such a big deal about who's going to be president, blah, blah, blah. The stock market actually does better under Democrats than Republicans, but only slightly. Everyone freaks out about it. But in the end, we're a huge economy. Policy can move it a little one way or the other, but we just kind of chug along.
Yeah, I mean, when you look at this year's election, obviously there's a pretty stark disparity between the economic policies of the two candidates. There's no question about it. In a typical election, you would have, a fair amount of, you'd have a fair amount of commentary from Wall Street talking about how much of a drag on the stock market Joe Biden's tax plan would be and so forth. But this is no ordinary election. This is no ordinary time. Certainly the outcomes of the potential for a vaccine and the public health outcomes really are going to swamp the differences between the two candidates' economic policies. You also have a Fed going into this election in ultra accommodative mode and telling you that it is going to stay that way well past the election. So that is a deadening. That's a factor that tends to deaden volatility. But it really stands out that the real risk factor when you talk with market participants and our clients is not about the outcome of the election. It's that's the process, the validity and the clarity of the process and the result is the big risk factor that they haven't had to contend with really in previous elections. But that's the number one concern around this one.
I'd love to come back and maybe in one of the next couple shows to have that conversation about just like what we think expectations are for how the election will play out and what will be perceived, and also just the way people think about it. Where you have this weird situation where I think if you spoke to most businesses, they're happy with low taxes and light touch regulation. At the same time, they're not happy about the policy volatility and rhetorical volatility that goes along with the Trump presidency, but they like the low taxes and low regulation. They may not be, very excited about, a Biden push for, higher taxes and re-regulation, but there is some comfort in that you're not going to have this worry about day to day that the president of the United States is going to be calling you out on Twitter and randomly, throwing, trade protection roadblocks in your way.
Well, we saw last night, the DOJ is rushing a case against Google, even though all their lawyers say we're not ready.
Yeah. So it's it would be a fascinating show and we'll do it. And Matt, I'd love for you to come and join on that. Maybe we can get, have a guest on to help talk through that a little bit too. But why don't we take a break here and come back and get into our last segment. You're listening to the Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, we're back on the Macrocast. John and Brendan, what do we have looking forward to next week?
Well, one of the things that the market is poised for is the European Central Bank meeting. That's on Thursday. And we got a little bit of a flash forward, perhaps, or a little bit of added intrigue this week when the ECB, the European Central Bank chief economist, came out and mentioned specifically that the strength of the single currency, the strength of the euro, is a factor in their estimates for the reflationary outlook. And that's not a big surprise. But the fact that he felt the need to come out and mention it specifically was not lost on market participants. The euro was knocking on the door of more than 2-year highs of $1.20 on Tuesday, and after this commentary, it turned tail and ran back down. It's come off a little over 1%. Over this week, which is a pretty meaningful move. It's down again versus the dollar. There's a sense that maybe the European Central Bank is going to, if not specifically not target the currency, but clearly put it as a prominent factor in their decision making. Maybe a little bit more of a dovish hint is coming next week. So we've seen a little bit. So we've seen some positioning ahead of that. And let's see, Brendan, what else is on the docket next week?
It's inflation week, so we get the PPI and the CPI for the U.S. And this one, it's for the August reading, will be kind of interesting because the first kind of 3 months of the lockdown was incredibly deflationary, and then you kind of had the math bounce back. So this is kind of the first one where we should actually get a relatively good reading of exactly what inflation is like for the average American and business.
And do people care anymore? Do we care? Do we care what inflation?
No, not at all.
Unless it's like
it's completely irrelevant. Well, the Fed's told you that too. You know, they're trying to make it go above 2, which if you pull up a chart from 1990, we only pop above 2% on core like for a few months at a time. So I've still never understood exactly why 2% is this magical number.
Yeah, I know. It's not magical for me either, but it is the target. And again, like I just you know, the target that you can't hit, you say you're willing to sustain it for a longer period of time. And so it's like,
yeah,
you know, my goal is to run a 4-minute mile. And to prove it, I'm going to say I'm going to sustain a 4-minute mile for, 2 miles.
That's exactly what, yeah.
Run a 4-minute mile.
Yeah. Yeah, I mean, I'm not a genius economist, but I can kind of look at numbers, and you don't see 2 very often.
Yeah, well, I'd love to see them do it. It'd be, we'd love to see them have that success. We'll look at the numbers next week and see if it's indicating that it's showing up in the real economy. It would be good to see.
We've talked about it before, the sort of statistical issues with inflation. And, if you're flying a plane and you've got a whole dashboard full of dials and you're focusing on, one dial that might be stuck, there's, you can make the argument that there's, a more holistic view is appropriate. But, it's obviously they've got the dual mandate and they're focused on in full employment as well, but narrowing the focus in this kind of economic environment, I think it's looking at one thing. It's such a confusing picture to really focus on one thing. It's simplicity and it's nice and it's clear, but it's pretty narrow.
Yeah, we should do a whole podcast if we want to lose a bunch of listeners to the quirks of the methodology of measuring inflation.
Right. We'd be like one of those go to sleep apps.
Yeah, exactly.
Right.
The irony is the number of people who we know would love to
actually they would love it.
Yeah, that kind of show is like licorice. Most people don't like it, but the people that like it really like it.
Yeah. All right. Well, hey guys. Well, we're gonna have a short week next week because it's Labor Day weekend. Everybody enjoy your Labor Day weekend. Those of you who are fortunate to be working, we're on the good side of the numbers on that payroll report we saw this morning. But everybody have a wonderful long Labor Day weekend and get some rest. You're listening to the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.